Welcome to the Real News Network. I'm Paul Jay, and joining us today is Greg Gordon. He's coming to us from the McClatchy offices in Washington, D.C. Thanks for joining us, Greg.
Glad to be with you.
So, Greg, you've just completed a brilliant, I think, piece of investigative journalism on Goldman Sachs and the subprime mortgage scandal, and in it you say this: Goldman's sell-off and its clandestine wagers, completed at the brink of the housing market meltdown, enabled one of the nation's premier investment banks to pass most of its potential losses to others before a flood of mortgage loan defaults staggered the U.S. and global economies. So, Greg, what did you find out in your investigation? How and why did Goldman do this?
We were always wondering how it could be that Goldman Sachs, of all the Wall Street firms, that Goldman Sachs got out of the subprime lending business and basically took, minor losses and escaped relatively intact while other Wall Street firms were melting down. So we tried to piece together the events surrounding its sales of subprime mortgage securities and related securities in 2006 and 2007, before everything kind of fell apart and unraveled in this industry. And essentially, there were two tracks going on. Goldman was buying these mortgages from some pretty high-flying lending companies, many of them out in California, and it was packaging them into securities and selling them to institutional investors. These would be pension funds, foreign banks, union health funds, and these investors were getting what they thought were AAA securities, AAA bonds that paid high yields and that would be safe. But actually, what had happened, as we all know now, is that these underlying mortgages that were backing up these bonds were not that far from junk. And when the default rates erupted, we had the meltdown that occurred in the fall of 2008.
Now, you point out in one of the pieces in the series that most of the people involved in this focused on California and Florida because they thought real estate prices would just go up forever, and it didn't matter if people defaulted because you could just resell the house for a profit. So Goldman, for quite a while, must have believed they had drunk the Kool-Aid themselves on this and thought there's really no downside. But at some point they realized, hey, this is Kool-Aid, and they decide to get out. And one of the people you interviewed talks about this looks so damaging that it appeared that the firm was actually going to dump these investments, thinking they're going to become toxic waste. So when does Goldman realize this, and what exactly do they do?
That's really the $64,000 question of the whole saga, Paul, because Goldman says that it had a meeting, a high-level meeting in December of 2006 after 10 straight days of losses in its mortgage business. And they then decided that they were going to start to sell off their subprime bonds. We'll call them subprime bonds. They include more than that. And they were going to stop buying mortgages. The date of that decision is elusive. Goldman won't part with that information. And at the same time, but actually earlier, Goldman began making what we describe as secret bets that the housing market would tank, essentially, and the value of these bonds would plummet, so that they were hedging themselves, as Wall Street firms like to say, hedging their risks. So the timing of all of this is more elusive than I'd like it to be as a reporter, but we know that in 2005 and 2006, Goldman bought $20 billion worth of protection from the big insurer AIG, the American International Group, which we all know later melted down. And so they had $20 billion in opposite bets all through 2006 and into early 2007 when they offered their last subprime bonds.
Now, let me ask you, when AIG melted, gets the bailout money, and then they pay Goldman Sachs its what the offer on the insurance policy, is part of it this money?
Yes. They had $20 billion, and when things started to sour in 2007 and 2008, Goldman started to demand from AIG that it post collateral, because this was part of the deal, that if the underlying assets deteriorated in value, AIG had to put up corresponding collateral. So what happened is that AIG put up $7.5 billion. Goldman wanted 10, and so they went and bought some other insurance elsewhere to cover the difference. And then as time went along, things just got worse and worse. And in the fall of September of 2008, when AIG was about to go up in flames and the government came to the rescue, not long after that, a decision was made to pay off all these subprime mortgage-related insurance bets that AIG had taken. See, AIG made a dreadful mistake. It did not go out and reinsure these bets because it assumed that the housing market would just keep going up forever, and that they were just collecting premiums every year from all these big banks and investment banks that were trying to cover themselves. So AIG ended up holding the bag, and it paid out $12.9 billion to Goldman, of which, for various contracts and arrangements that it owed money to Goldman for, and this included over $8 billion more related to these mortgage securities and the protection that Goldman had bought. So Goldman had that protection, but it was much more than that. They had made, they began making, after this meeting in December of 2006, many more secret wagers, we call them, secret little insurance policy arrangements with hundreds of counterparties, some on behalf of Goldman's clients and some to protect its own coffers. And then in early 2007, if not sooner, Goldman mortgage traders started making short sales against subprime bonds on a private market in London, where these exotic bets could be made using an instrument called a credit default swap. And it's these swaps that are really at the heart of the whole escalation of the risk that Wall Street took and that banks around the world took, because the swap market became a $16 trillion market just in the United States and over $60 trillion worldwide. So one of the issues, the key issues for us was, okay, so if you can do all this trading and these credit default swaps and you're out peddling these bonds to institutions like pension funds and insurance companies, don't you have to tell the insurance companies before they buy the bonds that you bet the other way with these secret swaps? And this is an issue that is being debated among the securities law experts that we spoke with. And some feel, the key is, what did Goldman Sachs know at the time? Goldman says, we had the same information as everybody else.
But that's not true. Goldman was working with the lenders. They had a level of detail of what's behind these loans that no one else could have had.
Well, I think one would argue that all of the Wall Street firms knew quite a lot about the quality.
No, I'm talking more with the people that, when Goldman sells some of this stuff to pension funds and to some of their clients that are not in the business, how are they supposed to know that what they're buying is junk when Goldman clearly knew? And
these bonds, and there were more than bonds. There were some instruments that they sold offshore as well, and we're talking tens of billions of dollars of those.
Well, in the next part of our interview, we're going to drill into the offshore piece of this puzzle.
Right.
So let's do that in part 2, and I encourage everybody to read Greg's series, and you'll find a link to it. You'll find it below the video on the McClatchy page. You'll find a link to it on the Real News page. And please join us for the continuation of our interview with Greg Gordon.